Hi, folks. This is Big Mike Zlatnik, and today's discussion is going to be all about should you do your own private lending or should you consider investing in a lending fund? And the reason it's important is that I've heard many of you asking me about some of the investments they made with the borrowers who have defaulted. They even disappeared. And it's recent news, and I feel terrible for the folks who have made these loans, and these folks have disappeared, or their files are just not performing. So there's no right or wrong answer. You can do both. This conversation is about giving folks framework to help doing it better themselves, or consider underwriting the right fund, or might be multiple funds, and investing through those funds with professionals who do lending for a living. So let me go through some basic concepts. So when you do private lending, you of course you underwrite the borrower first. And you need to know the borrower. You need to know who they are. Obviously, they could be wonderful, charming, great folks, but you don't know what's going on behind the scenes. And not only that, they could start and do good business for years, and then something breaks, and then they turn bad and even disappear. So what's important is to, of course, underwrite the borrower and keep checking on the borrower how they're doing, but it's also critically important to underwrite every investment, every asset, every loan that you make. Why? Because past performance don't guarantee future results. And a wonderful past borrowers who you build trust with can turn into folks that business falls apart, not necessarily for reasons in your control. That's why you got to keep underwriting the borrower, and you got to keep underwriting every asset. So when you underwrite a loan, you have to look through multiple characteristics, asset specific. What are you lending on? You have to inspect the property, do an appraisal, BPO, review of the property to make sure that you understand what are you lending on. The property is there, the condition of the property, especially if a loan includes rehab funds. And you want to draw those funds, disperse those funds over time with progress, not give the borrower all the money up front and then don't do the work, and then you're stuck with non-finished property. So again, property inspection is a critical element. Of course, you want to review the title. You got to get a title report. You need to understand, is there a loan ahead of you? Are the taxes paid? Are there other encumbrances, violations on the property? So getting a formal title report is critical. And also closing your loan through a title company is an absolutely a must. Why? In some companies, it's an escrow company. In some states, some other states, it's a title company. But the point is, you want to get title insurance, and you want to make sure that your lien is recorded. Title company has fiduciary responsibility to record your lien on a property versus closing the loan directly, funding to the borrower, and then relying or hoping they're going to record the lien on the property. So again, the proper process is to close through a title company with title insurance, also requirements for property insurance. All these things have to be reviewed and obviously approved by you. So there has to be an underwriting checklist. And I just mentioned a few key basic concepts that are required as part of the good, solid underwriting. There are other conditions. Of course, you need to understand loan to value ratio. How much are you loaning relative to the current value of the property and future value of the property? Sometimes it's called LTV on the as-is basis, and it could be LTV as repaired or as constructed. So understanding both of those components is important. Also, you obviously want to see some skin in the game from the borrower. How much capital have they brought into the property, or will they bring as part of the rehab process? All those parts of underwriting. And there are other elements to the underwriting. You have to understand the borrower's financials. You have to understand the project business plan. What kind of renovations they're going to do over what period of time? When are they planning to complete renovations, et cetera, et cetera? There are many steps in the proper underwriting. Can you do all that? Absolutely, you can. But it's work. It's work, and it takes experience and knowledge. And I mean this with all due respect. So if you're going to be in the business of making private loans, and you want to be purely passive investor, you still have to do the work. Otherwise, you're relying on the good behavior of the borrower. If you're making the loans to a borrower who was good and then they turn bad, then you can pay the price of complacent non-professional underwriting. And I mean this with all due respect. If you're a private passive investor, I have a lot of understanding of your challenges, but that's the reason to consider lending funds with professionals who do this work for a living. And it's not a perfect world. Some loans do go bad, but when you invest in a fund, and the fund has 100 loans, for example, or 50 loans, they diversify the investment. Even if a loan goes bad, there are many other loans that are just doing fine, and they will carry the diversification spread of the risk. So 1, 2, 3 bad loans on a 50 or 100 loan portfolio is not a big deal. So, and again, bad loan doesn't mean complete loss of capital, could mean foreclosure, could mean partial loss of capital, but the good deals take care of it. In a lending fund is a concept called loss reserves. So a fund should set aside a certain amount of capital in a loss reserve to cover the losses from a few bad files. That's the basic concept. So going to funds, you have significant benefits by participation through a fund. One is experience of the manager, their professional underwriting. 2, diversification. They're spreading the risk among many investments. 3, not only many investments, but many borrowers, many locations, and many projects. 3, in addition to all that, you have steady, predictable one investment versus you have a whole bunch of assets that you have to manage. So with a fund, you get one K1 at the end of the year. The fund might file for extension, may take a little longer, but you're not dealing with a bunch of loans that you have to track yourself. Did somebody pay you here or forgot to pay you there, et cetera, et cetera. So fund has multiple benefits from a single investment, diversification, better underwriting, experienced manager versus you doing it yourself. And again, if you do it yourself, you could save potentially on a fund management fees, and theoretically you can get returns slightly better. But is it worth it? Is it worth the risk? Are you doing this as well as the fund managers? Or is it better to pay a fund manager reasonable low-cost fees, depending on what kind of fund? If you find a high-quality fund with high-quality management team who do it well for a reasonable price, the risk-reward, in my view, is way better on a fund. And I'm biased. We're running these funds. So just full disclosure, our primary lending fund is Tempo Income Fund. We do this for a living. And we are proud of the fund, and the fund has done really well for investors. Now, full disclaimer, of course, read the PPM and understand what you're investing in. But you can do due diligence on a fund management team. You can do due diligence on a fund, and that's one work you're doing versus you're doing the due diligence on a whole bunch of assets, and as money comes back, you have to do it again and again. So all I'm saying is you could do this yourself, you could do it well, but it's going to be work. You're not going to be purely passive. You're going to manage your portfolio, and you have to be obviously diligent in your underwriting and portfolio and asset management, or you can do it through a fund like Tempo Income Fund. You can go, there are other funds. So certainly consideration, there are pros and cons to each. I just wanted to give you a little bit of perspective for consideration. And if you've been hurt by these private loans, I am so sorry to see and hear this. And we're all here to learn lessons, adjust, adopt, get better. And the consideration for funds becomes even more relevant in light of some of the challenges I've heard from individual investors who have participated with certain borrowers who have disappeared or failed or mistreated them. And lending today is actually a great time to be a lender, but you have to do the work, the due diligence in underwriting and diversification, all the elements that I mentioned, to make sure that you're not doing it the wrong way. So I appreciate your time and attention. I hope this was helpful. If you're interested in Tempo Income Fund or any of our funds or syndications, please reach out, request PPM to accredit investors only. Always consult with your attorney and CPA professional if you're making any investment decisions. Thank you kindly.